What if I told you that making money has very little to do with how smart you are, and everything to do with how you behave? You don't need to be a genius investor. You don't need to predict the market. And you definitely don't need to work 24/7. Yet, some people build massive wealth, while others struggle their entire life even with high income. So what's the difference? Today, we're going to break down one of the most powerful books ever written on money, The Psychology of Money, written by Morgan Housel. And trust me, this might completely change how you think about money. Welcome to Money Library, your place to learn money, mindset, and wealth building in the simplest way possible. If you want to become smarter with money without complicated jargon, make sure you subscribe and join our growing community. Now let's begin. Part 1. Money is about behavior, not intelligence. Let's go deeper into the most important idea of this entire book. Financial success is not about intelligence. It is about behavior. This might sound surprising, because we are taught that smart people make more money. Educated people manage money better. Experts always win in finance. But in reality, that's not how money works. Why behavior matters more than knowledge. Money decisions are not made in calm, logical situations. They are made during fear if market crash, excitement if market boom, pressure if losses, comparison if others getting rich. Even a highly educated person can fail financially if they panic sell during a crash, spend more to impress others, take risky decisions out of greed. On the other hand, an average person with simple habits like saving regularly, staying patient, avoiding unnecessary risks, can build massive wealth over time. Imagine two people. Person A, very intelligent, knows stock market deeply, watches financial news daily. Person B, basic knowledge, invests in simple mutual funds, doesn't check market daily. Now the market crashes. Person A panics, sells everything to avoid further loss, tries to time the market, keeps jumping in and out. Person B stays calm, continues investing monthly, ignores short-term news, thinks long-term. After 10 years, Person B often ends up with more wealth. Why? Because behavior is bigger than knowledge. Here's a simple rule you can follow. Create a system that protects you from your own emotions. How? Don't check your investments every day. Invest automatically every month like SIP. Avoid reacting to news headlines. Set long-term goals around 5 to 10 years minimum. Because the biggest enemy in finance is not the market. It is your own reaction to the market. Powerful line to remember. Good investing is not about being right. It's about not being emotional. Starting today, focus less on learning more strategies. Focus more on improving your behavior. Because at the end of the day, wealth is built by consistency, not intelligence. Part 2. No one is crazy. Let's understand a powerful truth. People don't make financial decisions based on facts. They make them based on their life experiences. Why this matters? Two people can see the same opportunity and react completely differently. Why? Because their upbringing is different. Their fears are different. Their goals are different. And all of this shapes how they think about money. Imagine this. Person A grew up in a family that struggled financially, saw parents worry about money, learned to save every dollar. The result is, they avoid risks and save aggressively. Person B grew up in a wealthy environment, saw money flowing easily, never experienced financial stress. The result is, they take bold risks and spend more freely. Now if both make different decisions, it doesn't mean one is wrong. It just means their life stories are different. Stop comparing your financial journey with others. Because you don't know their background. You don't know their risks. You don't know their responsibilities. Instead, build a strategy that works for your life. Ask yourself, what are my financial fears? What kind of life do I want? How much risk am I comfortable with? Then make decisions based on that. Part 3. Luck and risk. Here's something most people don't like to admit. Success is not 100% hard work. And failure is not always your fault. Luck and risk are always present. Luck is equal to things that go in your favor. Risk is equal to things that go against you. And both are often outside your control. Think about two people starting a business. Person A starts business before a market boom. Demand increases. Becomes successful. Person B, same idea, same effort. Starts just before an economic slowdown. Business struggles. Same effort. Different outcomes. Be humble when you succeed. Because not everything was your skill. Timing and luck helped you. And don't be too hard on yourself when things go wrong. Don't compare your Chapter 1 to someone else's, Chapter 10. Focus on what you can control. 1. Saving. 2. Consistency. 3. Discipline. Part 4. Never enough. This is one of the most dangerous mindsets. I just need a little more. Why this is dangerous? No matter how much people earn, they keep raising their expectations. First goal, 1,000. Then 10,000. Then 1 million. And it never stops. Many high earners earn huge salaries, still feel dissatisfied, take bigger risks to earn more. Sometimes, they lose everything. Define what enough means for you, because if you don't, you will keep chasing forever and never feel satisfied. Write this down. How much money is enough for my lifestyle? What kind of life do I truly want? Once you have clarity, stop unnecessary risk. Part 5. Compounding. This is where real magic happens. Compounding is equal to small gains plus long time, then you will get huge results. Why most people miss this? People want quick results, fast money, instant success. But compounding works slowly. Then suddenly, imagine two friends. Friend A invests $500 per month from age 22. Friend B starts at age 32. Invests $1,000 a month. Even though B invests more, A often ends up richer. Why? Time is more powerful than money. Start early. Stay consistent. You don't need big income, perfect timing. You just need discipline over time. Just take simple steps. Start investing today, even small amount. Don't stop. Don't panic. Part 6. Getting rich versus staying rich. Many people know how to make money, but very few know how to keep it. What's the difference? Getting rich requires risk, requires bold moves. Staying rich requires patience, requires control, requires humility. Lottery winners suddenly become rich, spend heavily, make poor decisions. Many go broke within a few years. Don't just focus on earning money. Focus on protecting it, managing it, growing it safely. Avoid unnecessary risks. Don't invest everything in one place. Always keep a safety fund. Part 7. Freedom. Let's redefine wealth. Wealth is not luxury. Wealth is freedom. What freedom means? Control over your time. Ability to say no. Living life on your terms. Imagine two people. Person A, high salary, no savings, stuck in job. Person B, moderate income, good savings, can take breaks. Who is richer? Person B. Use money to buy time, not things. Save regularly. Reduce unnecessary expenses. Build a cushion that gives you choices. Part 8. Stop trying to impress people. Here's a truth most people realize too late. People care far less about you than you think. What really happens? When you buy something expensive, you think people admire you. But in reality, they admire the object, not the person. You see someone driving a luxury car. Do you think, wow, that person is amazing? Or, wow, that car is amazing? Exactly. Don't spend money to impress others, because it never truly works. Before buying something expensive, ask, am I buying this for myself? Or for others? Part 9. Wealth is what you don't see. Real wealth is invisible. Understanding this concept, we see cars, clothes, houses, but we don't see savings, investments, financial security. That's real wealth. Imagine two people. Person A, luxury lifestyle, heavy loans. Person B, simple life, strong savings. Person B is actually richer. Stop judging wealth by appearance. Focus on increasing savings, building assets, not on showing off. Part 10. Save money. Saving is not just about money. It's about control. Why saving is powerful. Savings give you freedom, security, opportunities. Someone with savings can quit a toxic job, handle emergencies. Someone without savings feels stuck. Save even if you don't have a specific goal. Save at least 20% of income. Build emergency fund. Part 11. Reasonable is greater than rational. You don't need perfect decisions. You need sustainable ones. What this means: perfect strategies are hard to follow. Simple strategies are easy to stick to. Complex trading strategy is quit after losses. Simple SIP is continued for years. Who wins long term? The consistent one. Choose what you can stick with. Pick a simple plan and follow it for years. Part 12. Surprise. The world is unpredictable. Reality check. No one predicted financial crashes, pandemics. COVID-19 changed everything overnight. Always expect uncertainty. Keep emergency funds. Avoid overconfidence. Part 13. Room for error. Always leave space for mistakes. Why this matters. Things will go wrong. If you invest all money and market crashes, that leads to a big loss. Real life lesson you can apply is don't go all in. Simply keep backup money. Diversify investments. Part 14. You'll change. Your goals will change over time. The reality is what you want today may not matter later. In 20s we want luxury. In 30s we want stability. In 40s we want peace. Be flexible with financial plans. Review your goals every few years. Part 15. Nothing's free. Every reward has a cost. The truth is, high returns need high risk. Success leads to stress. Stock market returns come with volatility. Accept the price of success. Prepare mentally for ups and downs. Part 16. You and me. Different people play different financial games. Understanding this. Not everyone has same goals. Trader versus long-term investor has different outcomes. Don't copy others blindly. Simple action step is follow your own strategy. Part 17. Pessimism. Negative news spreads faster. Why? Fear grabs attention. News focuses on crashes, not growth. Don't let fear control decisions. Simply limit news consumption. Part 18. Believing stories. We create stories to explain success. Calling someone genius after one lucky win. The truth is, not all success is skill. Be careful who you follow. Look for long-term consistency. Part 19. All together. There is no perfect strategy. Personal finance is personal. Build your own system. Combine saving, investing, discipline. Part 20. Final rules. Simple rules win. Core rules. Spend less than you earn. Save consistently. Think long-term. Stay calm during ups and downs. People who quietly follow simple habits for years become financially stable. Avoid stress. Build real wealth. While others chasing shortcuts jump between trends, take unnecessary risks, often lose money. You don't need complex strategies to become wealthy. You need consistency and discipline. Create your personal money rules like, I will invest every month no matter what. I will not panic during market crashes. I will always save before spending. Follow them for years. And that's the complete breakdown of the psychology of money. If you truly understand and apply these lessons, your financial life can completely change. Because in the end, it's not about being the smartest person in the room. It's about being the most consistent. Now I want to ask you, which lesson impacted you the most? Comment below, I'd love to know your thoughts. If you found this helpful, like the video. Share it with someone who needs this. Subscribe to Money Library for more simple and powerful lessons on money. Thanks for watching. See you in the next video.